Okay, hi everybody, welcome to session 5 of the CISI programme. We're going to be looking at retail and commercial banking or borrowing today, focusing specifically on loans, mortgages and overdrafts. So this fits into chapter 3 of the qualification, a level 2 qualification around banking. So this is the first part of that. So before we get into the content, we're joined by 3 special guests today. So we've got 3 individuals who are working in investment management or asset management at the moment. So what we'll do first is we will hear from each of our guests, tell us a bit about what they do, who they work for and how they got into that position. So Arnold, would you like to start us off?
Absolutely. So thanks, Matt. As you kindly said, my name is Arnold Fomété. I've been an analyst at Goldman Sachs Asset Management. As of very recently, I've actually moved to a similar organization called Wellington to do a role in the UK institutional space. A bit of background about me, I studied business management at the University of Leeds, and I sort of got into the asset management industry, just sort of, trying my luck at various things, a bit of accounting here in university, a bit of marketing there, and then asset management ended up being one of the things that I was most fascinated by.
Thanks very much, Arnie. Tutu, can we come to you, please?
Yes. Hi, my name is Tutu Kamara. I'm a process assurance manager at Legal & General Investment Management. I came into the industry in quite a roundabout way as well. I started off doing a degree in biochemistry with French at King's College. Decided that career wasn't for me, and I did a master's to sort of gain wider skills in management and business. So from there, I went into accounting, did the ACCA, and started off in audit and assurance, and that's where I've moved through various industries. So I started off in practice, being an external audit manager, and then moved into banking as an internal audit manager, and then Legal & General, again internal audit, and then a couple of years ago founded this sort of new and bespoke department to look at end-to-end processes through the firm.
Thank you, Tutu. And last but not least, Monica.
Yes, thank you. So my name is Monica Yan. I work at Goldman Sachs Asset Management, so formerly with Arnie. And I have gotten into the industry through actually also a roundabout way. So maybe a little bit about what I do and then how that sort of ties out. In asset management, we work with all sorts of institutions. So whether that be a pension scheme, so making sure that people can retire and still get their pension payments, or with an insurance company, so that make sure that they have money to cover big catastrophic insurance events. We work with those types of institutions to make sure that they meet their financial goals. And how did I get into this? I studied business in university, and I actually studied marketing. So I liked marketing, the creative side of things, and I thought that working in my current role, which is in sales within asset management, is a good combination of marketing as well as finance. So that combination of marketing and business and finance. So that's how I got in.
Thanks very much. Thank you to all 3 of you. Really interesting how you've taken different pathways to get to where you are, obviously doing slightly different roles now. I'm also interested to note that some of you have moved from different areas of financial services into kind of asset management, although I know, Tutu, you still kind of got that focus, a bit of focus there on the kind of audit side, if you like. Some of the questions we sometimes get asked by students is, if I want to be an accountant, can I then move into another area of financial services, or if I want to work in here, can I move into here? So, and also in your case, Monica, marketing was the area that you focused on with your degree. So again, students shouldn't feel that you're kind of pigeonholed with the subjects that you take at university. If that's the case, always kind of The world's your oyster, a cliche, but you know, it's up to you. If you want to move into different areas, you do have those opportunities to do so. So thank you all very much. We're really lucky to have you here with us to go through this session, and I'm sure that you're going to have some really interesting insights and thoughts and opinions on some of this as we go through. Excellent. Okay, so in terms of what we want to cover in this session, we are going to look specifically at retail and commercial banking and the types of customers that use those services. So we're going to talk about kind of the difference between personal banking, corporate banking, and we're also going to look at what the terminology of commercial banking represents. And we're also then going to focus on different types of retail borrowing, but in particular, we're talking about loans, mortgages, and overdrafts. So these are services or products that can be used by individuals, members of the public, like us, if we are looking to borrow money. Okay, and in terms of, we sometimes put this slide up on the screen. In the last session, we spoke about how markets help to connect those that want to buy shares and bonds with those that are selling them. But this week, where we're talking about loans, if you cast your mind back to when we were talking about how retail banks make a surplus and make money, and how they connect savers with borrowers, that's really kind of what we're focusing on here, with the key focus on how people borrow money and the types of products and services they can use to do that. Okay, the first thing is really to look at the difference, what's meant by a retail bank and a commercial bank. Now, this is quite an interesting one that you'll find in the workbook, and we often hear this term commercial banks. Now, that tends to be a US or an American definition, which basically is an umbrella term for any sort of financial institution that takes deposits, so takes money in from savers, or those that want to put money with the bank, and any organisation, financial services organisation, that grants loans to similar individuals or companies. So commercial banking is traditionally a kind of US term or American term, an umbrella term that represents a number of different things, which in countries like the UK, we may then be a bit more specific about what those things might actually be. So commercial banking is this kind of umbrella term that will fit other types of services that take place. So within that, we have what are known as retail banks. And retail banks, which we might know them as in the UK, are those that you would normally see on the high street that specialise in taking deposits from savers and providing loans to borrowers. So if you think of the word retail, you often associate that with shopping and shops. And when we talk about retail banking, we're talking about banks that you generally find on the high street that manage individuals' money, and they provide those loans and those ability to save your money and deposit your money with them. So a retail bank in the UK is, in the American definition, a commercial bank because it lends and it takes money in from savers. But in the case of retail banks in the UK, they tend to be specifically for the general public, personal savings and personal borrowing. Is there anything that any of our guests wants to add to that, or do you think that that's a satisfactory definition of kind of commercial banking and retail banking?
Yeah. Absolutely. The only thing I would add is for retail banks, that's probably our first introduction into banking in general. I know that when I was young and I started getting an allowance and I was able to save up some money into high school, the first thing that I did was actually get my own retail banking account and going into, well, I'm from the US, if you couldn't tell by the accent. I went to a Bank of America, so the equivalent of, I would say, a Santander or a NatWest here, or HSBC. So I think that's something that hopefully will be familiar to everybody.
Thank you. That's really interesting because we don't see any Bank of America branches in the UK, do we? From a retail banking perspective, Bank of America's got a slightly different role as a bank in the UK. So it's interesting. In the US, do you also have JP Morgan branches? Are there also
yes, absolutely.
Branches? Yeah.
JP Morgan, Citibank is also a big one. HSBC is also actually active in the US, and I know some people use them to deposit their savings accounts as well. So these are all sort of well-known, recognized names across the US. But obviously in the UK, we have a whole host of different names that we're familiar with here.
Yeah, absolutely. So we have banks like Barclays. Monica's already mentioned HSBC, Royal Bank of Scotland, RBS. Yeah, there's so many. Lloyds Bank. So many of them are nationwide. Thanks, Pete. So nationwide, we would term as a building society. Well, they are a building society, aren't they, nationwide?
Yeah, they are. They are technically a building society, and the key difference, as far as I know, is that it's owned by the members, not by shareholders. So hopefully, it should mean you get slightly better terms both as a borrower and a saver. However, going into it, the sorts of products they offer, you know, they're pretty much the same as any other retail bank, you know, now.
Yeah, but, absolutely. Yeah. Yeah, thank you. Yeah, absolutely. The as you say, building societies tend to be they're not owned by shareholders as banks might be. It's their members or people that deposit with them. That it's almost a bit like a partnership, isn't it? It's a bit like John Lewis. It's kind of the John Lewis model of retail banking, if you like. Another one, it used to be Abbey National in the UK, which then Santander took over. So again, there's different types that offer retail banking services. So, but generally it's those that you see on the high street. And as Monica was saying, you know, they have in different countries, you will see different banks, different names of banks that you wouldn't necessarily see in the UK. And also in the example of JP Morgan, Bank of America, they have different, they provide different products and services in different countries. So JP Morgan in the UK is an investment bank. It doesn't have a retail banking role, but in the US it does. So when you go to different countries, you might see different names, different banks that don't operate in the UK that operate in those countries. Now, the second type of kind of bank that sits under this commercial banking umbrella that we need to be aware of are corporate banks. Now, these are banks that do a very similar role to retail banks, but instead of taking deposits and lending to individuals or the general public, they lend to businesses. Okay, so they take deposits and they lend to businesses. Now, one of the points to kind of make is that what you often find is that in the UK, retail banks offer corporate banking to businesses as well. So you may find banks that are purely corporate banks, but other banks, a lot of retail bank, high street banks, have a corporate banking arm to them. So they do also offer banking services to the public as well as businesses. So some have a kind of dual role, but some you would definitely kind of sit and think like they are a corporate bank. That's all they do. They lend to businesses, take deposits. But a lot of the time you find that retail banks and corporate banks are the same entity. They just provide products and services to different individuals or businesses. But generally speaking, those two types of banks fit under this commercial bank definition. But as we say in the UK, you kind of separate them out slightly into retail and corporate banks. Great. Anything that any of that Monica, Arnie, Tutu that you want to add before we move on from here?
I was just going to add, just before we moved on from the retail banks, that we also have a whole swathe of new retail banks that aren't on the high street, Monzos, Starlings, you know, those sorts of banks. So they offer pretty much the same services as your traditional retail banks, but you know, for maybe younger people, they're easier to navigate with the apps and stuff.
Yeah, absolutely. That's a really good point. Yeah, we have seen, haven't we, a number of banks, different types of banks without that kind of high street presence that you can now go into to try and offer, should we say, more customer focused products and services. And I think, would you say that became in your opinion, would you say that became a trend after the financial crisis, that we kind of saw different types of these new types of banks coming out of the woodwork?
I mean, I'd say so. So the very first one of these that was sort of online and telephone only was First Direct, and that existed for a long time on its own. So yes, you're absolutely right. It's only in the last 10 years or so that you've started seeing these new challenger banks springing up, offering slightly different things, to be fair. Some things better, some things worse than traditional banks.
Yeah, thank you. Yeah, absolutely. Tutu there alludes to the term challenger banks, which is the umbrella term that describes these new types of banks making a challenge to the well-known names in banking, to kind of almost try and what they would, I suppose, see as offering an alternative to the mainstream retail banks that are out there. Thanks very much. Brilliant. Arnie, Monica, anything you want to add to that? Or are you happy with everything we've spoken about there?
Happy with that.
Okay, excellent. Fantastic. Okay, so looking at the difference between retail, corporate and commercial banks, we just kind of summarize those up. And I think we've spoken about this at length, really, just to kind of summarize that the retail banks are there for individuals. They provide customers with services, so individual, personal banking, and they are there to attract the savings and those that want to borrow on a personal level. And commercial banks also incorporate corporate banking as well as retail banking, and that's this kind of umbrella term. So the corporate banking is, as we said, it's about taking deposits and lending to businesses, and also, as we said, sometimes retail banks can also be corporate banks. So that just kind of summarizes some of the key things to take on board there. Okay, so we're going to start looking at different ways that we could borrow money via a retail bank. So personal banking, so how individuals can borrow money. But first of all, let's kind of think about, why do people borrow money? I'm going to throw this out to Tutu, Arnie, and Monica. Have you borrowed money in your lifetime, and how have you done that, and why did you do it? If it's not too personal.
Yeah, absolutely. After you.
No, please go ahead. I'll chip in after you.
Sure. I guess an example I was going to give, maybe on a more smaller scale, earlier in my life, was I've borrowed money, for instance, just from my parents, just because I had an idea of wanting to basically collect some old comic books that were being basically discarded at a store near us, knowing that a lot of my friends would want to read them, or a lot of people in my class. So I basically asked my parents for a loan to basically buy these old comic books, and then would basically set up with my friends sort of like a very small mini library, if you will, to have other school kids come and read these comic books at a price that, I would then pay my parents back for the money they'd loaned to me. So I guess that was one of the early examples of where I thought, okay, I don't currently have money. How can I maybe ask my parents to loan me some money to explore a business opportunity or an idea, with the idea that I'd pay them back in the future?
Very entrepreneurial. Arnie, did they charge you interest?
They did, unfortunately.
Excellent. Well, it teaches you the cost of borrowing, doesn't it? So that's fantastic. Great example. Brilliant. Thank you. Sorry, Tutu. Yes, you were going to say something as well.
Oh yeah, so I was going to just give a couple of little examples of where I've borrowed money. So for example, I've borrowed money for a mortgage, which I would class as, which is one of the better reasons to borrow money. So I was just going to talk about sort of good and bad reasons to borrow money. So borrowing money for a mortgage, you have enough money for a deposit. It makes sense. It made sense from my point of view to buy a house rather than rent a house, so that, you know, eventually I own this house and I don't have to pay rent anymore. Also, I've borrowed money in the past for a car. Again, I needed that to get about, and for me that again was a good way of borrowing money, a good reason to borrow money. Bad reasons for borrowing money, in my point of view, are for things that actually you don't need, but maybe you get pressured, or for whatever reason you take on this debt. So, for example, when we could go to shops, you would have people urging you to sign up for store cards, or sometimes even when you're online, you know, you can sign up for ways of deferring your purchase. And a lot of times this isn't stuff that you need, and a lot of times the interest rate is humongous, so you end up paying very, very expensively for something that you don't need. And the other knock-on effect, of course, is that, you know, if you end up not being able to afford it, you default on the payment, and that affects your credit rating, which makes it harder to borrow in the future. And even if you can borrow, it's very, very expensive. So thinking about why you want to borrow, I think, is very important. There are good reasons and there are bad reasons.
Yeah, thanks, Tutu. That's really important to consider. You're absolutely right. I certainly have been guilty of borrowing money for not particularly good reasons in the past, and you end up in this. I ended up in a cycle of debt, which was very difficult to get out of. And Tutu says, you know, if you don't pay the loans back, or however you borrowed money, you get a black mark against your credit record, which can cause you problems if you ever need to borrow money in the future. So you do have to be very careful. And as you said, Tutu, that kind of conflict between what you want and what you actually need is something, especially in quite a commercial world that we live in, quite a materialistic world that we live in. Sometimes you really want something, you know, if you really want that PlayStation 5, but do you actually need it? It's going to cost you £500. Can you save some money up? Can you wait until spread it over a birthday and a Christmas present or something like that? Do you actually need that? It might just be that you want it and you can do without it. So I think that's really good points there. Thank you both there. Monica, anything that you'd like to add to that at all?
Yeah, so I think borrowing money, one of the biggest ones that is in my memory is borrowing money to go to university. And I went to university in the US. And I guess if I apply Tutu's logic in terms of good versus bad borrowing, I would classify this as carefully considered good borrowing, hopefully, because you are borrowing quite a large sum of money so to get an education, in the hopes that you are able to find a job later on that will sustain you for the rest of your life. So that's how I went about that calculus. And it was quite a large sum, so there was interest that needed to be paid as well. And it did take me a few years after graduating to pay that off. But I do feel that that was the right decision to make at the time.
Thank you. Certainly, in the UK, if you're going to university, the student loan is probably, apart from a mortgage, probably the cheapest form of borrowing that you will have. Although I know it's certainly got more expensive compared to when I went to university. So it's it's like you say, that kind of fits into that good debt, if you like, as Tutu was saying there. So thank you very much for your stories. And Arnie, if I ever want a comic collection to build, I know the man to come to sort that out. I think that's brilliant. What a fantastic idea. Did you make money? Did you make money, by the way?
We made enough money to buy a couple ice creams that summer, which was, I guess, money well spent.
Absolutely. Especially how old were you when you were doing that?
We were 8.
Yeah, well, fantastic. Yeah, that's all you want. Couple of ice cream, very entrepreneur at 8 years old. That's extremely entrepreneurial, and good on your parents as well for kind of educating and allowing you to do that. I think that's fantastic. Excellent.
Thanks,
okay, on the next slide, I've just got some examples of why you might want to borrow money, and Arnie, Tutu, and Monica have spoken about these. And some of these, Monica spoke about going to university, study courses. You may need to borrow money to do that. Tutu had spoken about money to buy a car, to buy a property. Arnie actually referred to really borrowing money to start a business. And that's another reason you might want to borrow. We've got some interesting things up there, like paying bills. Now, that's where things can become quite dangerous. Also, paying off other loans. Now, sometimes you can borrow money at a cheaper rate of interest to pay off other debts that you might have. And certainly, if we take some examples of businesses, there are some businesses that will do that and borrow at a cheaper rate of interest over time, and therefore settle up other loans with that money. And individuals can do that as well. It's kind of it's a slightly strange situation, but you can borrow money more cheaply to pay off other debts if you find yourself in an unfortunate position to have to do that. So I'm not condoning that, just saying that sometimes that happens. Sometimes people need to borrow money in the case of an emergency. Maybe they are near to when they're going to get paid and they don't have the money sitting there to be able to do something. Say your car breaks down, or the washing machine breaks down or something like that, and you need money quickly to pay for things that you actually need. So it comes back to Tutu's point about the difference between wants and needs. Do you have to have that, or is it just that you want to have it? So when you're borrowing money, you have a lot of things to consider, and one of the things to consider is how you borrow that money. So what is the most suitable way to actually borrow that? So we had some case studies, 3 case studies that we asked you to look at from the previous session. And the first one we come to here was this lady called Jenny. So these are examples of individuals that have borrowed using certain methods. So in this case, Jenny is a graduate and she started working full time. Her job is some distance from her home and public transport system isn't great. Sounds like London. She decides that she needs to buy a car. And she finds an ideal vehicle, so she's going for a second-hand Volkswagen Polo. I don't think it's got a bad boy exhaust on it or anything like that, but they will cost around £6,000. So she doesn't have much in savings, so she goes to her bank and applies for a £6,000 personal loan. So the bank issues the loan unsecured, and we'll come to what that term means in a moment. And the terms of the loan are that she will have to repay it within a set period of 3 years. And they've given her a defined repayment schedule. So in other words, they've told her how much she has to pay every month, and that's how it will be for that 3-year period. So this will allow her to budget for the repayments, and they will be paid back monthly at a set interest rate of 8% per year. So we're talking here about a personal loan. And the first thing really is kind of what are loans used for? Now, I think from what Monica, Tutu and Arnie have been talking about, as we said, different types of borrowing have a different purpose. You would use them in certain situations. Now, in this situation, Jenny wants to buy a car, and Tutu spoke about the fact that she took out a loan to purchase a vehicle. Now, one way of doing this, you can go through specialist kind of vehicle financing companies that are normally part of the dealership. If you go to a dealership, you can take out car finance that way, or you could take out a personal loan via a financial services firm like a retail bank and get the money there to borrow to purchase that vehicle. So when we're looking at loans, really we're talking about you might be looking at purchasing normally a one-off kind of what you might call a big ticket item. So something that isn't something you necessarily would be able to afford to purchase straight away. It might be something you'd have to save up for over a period of time, but you might need it now, and to get it now, you will borrow that money to do so. So it might be that you're looking to purchase something that's quite an expensive item, or something like a big ticket item, a car, or potentially a new washing machine, or your PlayStation, whatever that might be. So generally something that's probably worth about £1,000 or more, you're probably going to take out a loan for. Now, interestingly, when we look now at actually how people shop, what I'm seeing a lot more now is options for people when they want to buy something large. It doesn't even have to be something that's particularly expensive. they're now offering terms where people can split the payment up into 3. So I think Klarna is an example of an organisation that offer these types of services. So that can be quite a bit of a pitfall to fall into as well. So it might look particularly cheap, but if you've got a few of those few items you've bought on Klarna payments, and suddenly every month you've got smaller payments, but you've got a few of them coming out, that can be a little bit dangerous as well. You have to be careful of that. Sorry, Tutu, were you going to say something?
I was going to make it. I was going to make that point actually, that it's worth shopping around for how to fund things, just as you would shop around for anything else. So in the example you gave, you could go for a loan, you could go for the dealership, you could just. It's definitely worth shopping around. They're usually, sometimes you can even get interest-free finance from the vendor. Yeah, that's what I was going to say.
Yeah, thanks. You're absolutely right. Especially if you're buying a car now, they very much a lot of dealers offer 0% interest on car loans or car finance. So you're absolutely right. Because there's a lot of competition out there. You often don't just come across the first offer that you might get. You can have a look around, and it's really interesting that you should mention that, because in the Google Classroom here, I've put a link to the Money Saving Expert website, which is for those of you that aren't aware of that, it's Martin Lewis, who's done a few programs on TV about personal finance, and their website recommends the best the loans with the best interest rates, the best savings accounts, giving you. So if you're interested in that, please do have a look on the Money Saving Expert website, and the link is in the Google Classroom amongst the resources there. Okay, also around loans, how do they kind of work? Some of the things that have come up in this case study here, there are kind of advantages and disadvantages, but also the way they work that might benefit the borrower. And I think probably one of the key things to pick out here for Jenny is that she was quite interested in having the defined repayment schedule. So the certainty of knowing when a certain amount of money was going to come out of her account, so that she could budget and make sure that she had enough money for everything else she needed around that loan repayment. So that just helps to make things more certain, helps to plan your finances, helps you budget, make sure that you've got the money there to pay for it, and that other things that you need to pay for can also be considered as well. Okay, from any of our guests, any other kind of advantages or disadvantages you think we're kind of taking out loans, or some interesting points from Tutu about shopping around? Monica, did you?
Oh, I was just going to say, one of the advantages, clear advantages for me, at least at the time when I was borrowing, is that when you are paying back, the monthly payments that you make are in much smaller bite-size amounts that are easier to pay back, especially as a student or as a young person and just starting out in life and getting a new job, where you won't be able to, even at a later date, pay that lump sum in a one go. So it does help make it easier in terms of breaking it down into smaller pieces with a little bit of interest added on top, rather than deferring for just a lump sum payments.
No, absolutely. Yeah, thanks, Monica. So in terms of kind of the key features of the bank loan, as we've said, so this is where you receive a certain amount from the lender to purchase an item or whatever you need to borrow that money for. So the borrower, the person borrowing that money, they agree, there's basically a contract between you and the lender that says that you agree to pay a certain amount monthly. So there's a certain term, so it might be for a number of years, 1 year, 2 years, 3 years, whatever that is. I mean, most loans I've come across normally kind of a maximum term of 5 years, often with car repayments. If you're borrowing money to buy a car from a loan, normally about 4 years is probably about the maximum amount of time they will go up to. But you can get loans that may go beyond that, but have even shorter terms. So you agree to the term, the amount of time that loan will be, the amount of money will be borrowed over, and then you pay that back on a monthly basis. And you agree to do that. You agree to the amount that you will pay. You you agree to, when that money will be taken out of your account. So it gives you that certainty. And as Monica said there, it spreads those payments over a period of time, so it makes things more easy to manage. And as we saw with Jenny, she was able to budget everything around that. So as we said, the loan is normally for a set period, and it often has a set rate of interest. So here's another really important point. Interest rates can change. Okay, so we are living in since the financial crisis, we've been living in a strange time where interest rates have been extremely low. So borrowing has been quite cheap compared with other periods that we've lived through. And also interest rates have tended to go down rather than up. There was a lifetime that we lived in where interest rates actually did increase, and they probably will do, who knows when. But interest rates can go up, and what a loan will allow you to do is it fixes that interest rate for you. So in the example of Jenny, she had 8% interest. She knows that that's the set rate of interest she will pay across the term of that loan. So there's no risk that suddenly the bank can put that interest rate up and it becomes more expensive to pay that loan back. Okay. And the other big advantage is that defined repayment schedule. So knowing that for a period of say 3 years, you're paying a certain amount off. Sorry, Tutu, did you want to come in there?
Yeah, I just wanted to add that you can get tracker loans, but this is especially for mortgages, and that just depends on how you think interest rates are going to go. So then they're normally cheaper, but they will normally go up and down depending on how the Bank of England base rate goes up and down. So you can have a floating interest rate rather than a fixed one.
Yeah, thanks, Stacey. Absolutely, and we'll talk a bit more about that when we'll come to the mortgage and the next one we'll look at. So, the other thing to bear in mind, actually, off of this is that when we're looking at this case study, this loan, a personal loan, tends to be what we would call unsecured, and this is quite an important term to consider when you're borrowing money. But an unsecured loan means that there doesn't have to be an asset, or there doesn't have to be something that's put in place when a loan's taken out that means that if you can't repay that loan for some reason, that you have to sell something or offer something that the lender can then take and sell to repay that loan. So an unsecured loan means that you don't need to have something sitting there that's of the same value of the loan that would have to be sold in order to borrow. So obviously that means then that individuals that don't have assets, it doesn't exclude them from being able to borrow money. It just means that it's they don't have to put any asset as collateral to say, if I can't pay this loan, you have the right to take this from me and sell it. So if it means that you've got an expensive TV and you take out a loan to buy a car, the lender isn't going to turn around and say, right, okay, well, we want to have your TV and we will sell that if you can't pay your loan to us. So you won't get the bailiffs knocking on the door, coming to collect the asset and to sell that off. So if you might see programs like, I think it's if you can't pay, we'll take it away and things like that. There are lots of programs on television that you can watch where it looks at bailiffs going into businesses a lot of the time, trying to take assets to repay money that's owed to somebody else. So in the case of personal loans, they're often unsecured, which is good because it means that if you don't have that asset there, you can still go and take that loan out or apply for that loan. Okay, excellent. So that's personal loans there. We've covered that. So our second one was this lady called Jade. She's a new graduate. She started working full time and she's got some wealthy parents. Sounds like your parents, Arnie, giving you the money to set up your comic business. And they've encouraged her to buy a home of her own. She's found a property that's ideal, but it will cost her £250,000. So they've agreed to give her, parents have agreed to give her a £50,000 deposit towards the property, the cost of the property, but she will need to borrow the rest from the bank in the form of a mortgage. So Tutu has spoken about mortgages previously. So the terms are that Jade will make monthly repayments over 25 years. The interest rate for the loan will be at the bank's standard variable rate. So actually this links into what Tutu was saying earlier about having a mortgage or a loan that varies in its interest rate. So it's currently 6% interest, but it's liable to change. So in the event of Jade failing to make the required payments, the bank has the ability to take ownership of the property in order to recoup the money owed. Okay, so this comes back to the security. Is it unsecured or secured? Okay, so as we already know, a mortgage is the loan you take out to purchase a property, to buy a house. So what are some of the big kind of advantages and disadvantages of mortgages? I think we've kind of alluded to some of these. So it's going to be cheap. Okay, a mortgage is going to be cheaper than other loans that you will take out, and there's several reasons for that. One is that you normally take it over quite a long period of time. So mortgages at the moment, you can probably borrow up to about 30 years. So depending on how old you are and how close you are to retirement and the prospect of not working anymore, the longer you can borrow over. So normally mortgages, the loan is over a 25 to 30 year period. So it's over a period of time. So therefore the interest rate is normally less. And this comes back to kind of risk and reward as well. The risk and reward topic that we spoke about a few weeks ago, that also has an impact on the level of interest or the rate of interest charged to those borrowing the money. So the other thing that Tutu spoke about was the fact that you can have a different or variable rates of interest. So for some people taking out mortgage, they select the fixed rate interest option, and that comes back to the previous case study we had there, where Jenny knew how much interest she was going to pay every month. So a fixed rate mortgage, you know that the interest rate will not change, even if the base rate of interest changed nationally in the UK. So you know that your mortgage interest rate will stay static for a period of time. It won't go up and it won't go down. In the case of Jade, she's taken out what's known as a variable rate mortgage. So when she took it out, she was paying 6% on the money borrowed, but actually that could change in line with changes in interest rates set by the Bank of England or whatever rate of interest they got it linked to. So variable rates of interest tend to be a bit riskier. Now, if you've got a fixed rate mortgage with a set rate of interest, that is less risky for you as the borrower because you're not then exposed to increasing costs of the mortgage. Therefore, it might be that they charge you a slightly higher rate of interest because you basically are taking advantage of the fact that you've got that static rate of interest or fixed rate of interest there. And also it means that the lender, if interest rates go up, they won't benefit from that interest rate rise. So they won't receive a greater return on the money lent out. So again, the type of mortgage can determine the kind of interest rate that you are expected to pay. And remember, kind of the more risk taken by the lender, probably the higher the amount of interest that you will end up paying. Okay. And finally, on the mortgage here, we've got the fact that this is as a property, taking a mortgage out to buy a house, the house is the asset that goes against the loan. So this isn't an unsecured loan. A mortgage is a secured loan. It's secured against the property. So if you as an individual with the mortgage cannot repay it, then after a period of time, the lender, the bank, whoever it is that's lent you the money to buy the house, they will have the opportunity to what's called repossess that property. So they take back ownership of that property and they will then look to sell it to get their money back. And the misconception normally is that, oh, well, you know, any ownership or level of equity I have in that property, I will get some money back when the bank sells it. Well, that's not always true because the bank are only really interested in recouping the money that they have lent on the property. So if you've got, say you own £50,000 of the property, as in this case Jade did, if the property is repossessed and the mortgage was for 200,000, and when they sell it, they only get 200,000, Jade won't get her £50,000 back. because the bank is only interested in recouping the money that they lent to the person that purchased the house. Okay, so that's, just remember that with a mortgage, the property is the asset that's put against the property. The bank can take that if you are unable to keep up repayments on that mortgage. As we said, it's a cheap way of borrowing money. Probably one of the cheapest way, apart from a student loan, that you will borrow money in your lifetime as well. So as we said, it's a secured loan there. Sorry, I've gone on for quite a while there. Anything that Monica, Arnie, Tutu, anything you want to add to that?
Nothing from mine. I think you've covered it.
Okay, great stuff. Excellent. Brilliant. And then the final method of borrowing we're looking at here is this individual, Nadia, who she's a writer and her income varies. So some months she earns quite a lot of money, but in other months, other periods of the year, she's quite quiet. So in this case, she travels rather than writes. We'd love a job like that. So her income can fall off at certain times of the year. So because of her variable income, she has an agreement with her bank that she's allowed to spend up to £1,000 more money than she has in her bank account. Okay, and so she used this during those lean summer months where she doesn't have as much money to keep her in this fantastic life that she has become accustomed to. Okay, so she has what's known as an overdraft facility. So in this case, there's no set date or schedule for repayment. However, the bank is able to remove this overdraft facility whenever it wishes to do so. And there is the expectation that she will be able to repay the overdraft during the busier winter months. So the bank charge her an interest rate of 10% per year, but that can be changed at any point. So it's variable, as Tutu mentioned before. And it can be changed as long as the bank gives her 14 or 2 weeks notice of the fact that interest rate will change. She also has to pay a one-off or annual arrangement fee for that overdraft, which is £50, and she pays that at the start of the overdraft facility. Tutu, Arnie, Monica, have you ever used your overdraft? Have you ever been an avid user of an overdraft facility?
I have not personally, but I do know of people who have.
Not even when you were a student, Monica?
No, I was actually a very careful, not fun at all student.
Yeah.
Sorry, Arnie, you were going to...
Sorry,
Arnie, I thought you were going to say something there.
Oh no, I was going to say same as Monica. Actually, I know I've got a few friends who have, but I haven't personally.
I will add. I've definitely been an avid user of an overdraft, and I can say it's useful. It's useful when you need it. Absolutely. When I first started out, I'd moved out. I was living by myself by then. So yeah, I used it a lot. It's something you have to be careful for when you're using, because it's very easy to think of it as your own money. If you are always going close to the overdraft limit, it's very easy to slip over the limit, and then you usually get hammered with quite hefty charges. And if you are living that close to the edge, it means that you don't really have any cushion for emergencies or unexpected expenses. So they are very useful, but should be used judiciously. That's what I would tell my younger self.
Yeah, absolutely. Yeah, if I reflect my own experiences, I have one, but I don't use it. But when I was a student, I was in it constantly.
Yeah.
And you have to manage it. You can't just ignore it. You have to kind of be really conscious about budgeting yourself and understanding where that money is going to come from to pay it back. So I always found it really quite effective to go into my overdraft during these semesters that I was at university, and then in the summer I would then work all summer to pay it back. So it was kind of like you would go into overdraft for maybe the first semester of the year, I'd then get my student loan payments, so that cleared that off. And then I would start again, go back into my overdraft. And then in the summer, I would work, pay it off and put some extra in my account. So for the 3-4 years I was at university, that was kind of the cycle. And if, as long as it's managed, and you know, and you understand what you're doing with it, and you, as you say, Tutu, you kind of, it's that perception that, oh, it's not my money. Well, it is, you're borrowing it, so you have to pay it back. And the big risk with these overdraft facilities is that these banks can actually just turn around and say, well, you can't have that anymore, we need it repaid. At the drop of a hat, they can just turn around and say, no, we're not going to give you this anymore, we're taking this facility away, you need to pay that money back. So again, it's quite risky from that perspective. So you have to be really careful with it. Yeah, some good points there. Anything anybody wants to add to that? No? Okay, so to kind of summarize with an overdraft, I mean, what we're actually talking about here, to kind of define this properly, is the bank allows you to take out more money from your bank account than you actually have in it. So when you get to a zero balance, you've got no money in your bank account anymore. If you have an overdraft facility, you can then withdraw more money than you've actually got in that bank account. So it's a form of borrowing, it's a form of lending, but it's slightly different. And as Tutu said, and Arnie and Monica said as well, it's kind of flexible way to borrow money. It gives you some flexibility, it gives you some freedom. So unlike with a loan where you have set repayments, you don't have that with an overdraft. But that's where, if you don't manage it properly, it can become slightly out of control, when you can get charged lots of interest, you might get charged fees on top of that. So it can become really quite an expensive way to borrow money. So it's meant very much as something you use in the short term. You're not meant to be in it for long. So kind of use it for emergencies, or if it's an interest-free overdraft, as you might have as a student, it's about managing that properly and repaying it and then going into it again if you need to. So it is something that has to be managed, but really should be used for short-term borrowing in a case of either an emergency or in circumstances like that. So you've got this advantage that it's flexible, but some of the issues might be that, again, you get a variable rate of interest. Some of the fees can be quite high, and the bank can demand repayment of that overdraft when they want. So you've got no certainty around, oh, do I have to pay it back? No, I don't. You just never know when you might get asked for that, unlike the bank loan, where you know you pay that back on a monthly basis. It's unsecured, like the personal loan is, so you don't have to put an asset against the overdraft. But the big thing that you should be aware of as well is that what sometimes banks do, which can be a little bit cheeky, is they will allow you to withdraw more money than you've got. So they'll give you an overdraft facility without you actually asking for one. Okay, and if they do that, instead of just refusing your card and saying you can't withdraw money, they allow you to take money out, and then they start charging you exorbitant interest on that. And that's what we would call an unauthorized overdraft. And in fact, those sort of interest rates that you see on unauthorized overdrafts when the bank hasn't approved it can be extremely high, sort of payday lending high. They can be very high interest rates. So it can become a very expensive way to borrow money. So the advice, as we said there, short term. So if you've got something that's an emergency that you need to pay for, an overdraft can be quite a useful way of doing that if you know you're going to be able to pay it off in the short term. But it offers some flexibility to you as the borrower, which is really good. But don't try to go into an overdraft that isn't authorized by your bank. You will get charged very, very high rates of interest. So unauthorized overdrafts, you have to be very careful of. Always make sure that if you've got an overdraft facility, it's authorized by the bank, it's agreed. And some, if you're lucky, might even have it at 0% interest for a period of time. So just be wary of overdrafts. They can be really useful, but they can be have a number of pitfalls with them. Sorry, anything that anybody wanted to add before we finish off there? No? Okay, excellent. Right, so that concludes looking at these 3 different types of borrowing and looking at kind of different types of looking at the definition of commercial banking, retail and corporate banking. So what you can do on the Google Classroom, there is a multiple choice test which you can have a go at. There's 5 questions in there just to test your knowledge about retail banking and the different types of borrowing that we've covered off there. And then for the next session, what would be really good is to have a go at the pre-session task, the 2 tasks that are in there. So the first is to read pages 27 to 29 of the workbook to recap on what we've spoken about here. And then the second one, which we will cover off next week, is doing a similar type of research that you did with the case studies, but looking at payday loans in particular. So carry out some online research to answer some questions about payday loans, specifically how they work, who they are meant for, advantages and disadvantages as you had with the other methods of borrowing, but also what changes were made to UK law or legislation that regulate and control payday lending. So just some things to look at for the next session, which will inform you when you look at that as well. Well, that concludes everything. I just want to say, is there anything, Tutu, Arnie, Monica, is there anything that you want to add before we finish off there?
All good from my side.
Okay, excellent.
Likewise.
Thank you very much.
Nothing from me. Thank you.
Thanks, Arnie. Thanks, Tutu. Brilliant. Thank you very much for being here and giving us some personal insight into ways you've borrowed money and some of the pitfalls and the advantages of doing this. Really useful to have you here. And thank you also for telling us about your careers, how you got there and what you do. And I think Monica, Arnie and Tutu will be joining us for a few more of the sessions going forward as well. So thanks very much, and we will see you during the next session. Take care.
Thanks, Max.